I've got Mr. Jay Pestrichelli joining me from Tidal Funds, Chief Trading Officer at now a $45 billion shop with a lot of growth in the past year. Jay, great to see you.
Yeah, Oliver, great to be here. Good to catch up, man.
Yeah, we've been talking for a long time about options and strategies and funds, and the Tidal story now is one that a lot of people know, a lot of people have heard about. I think a lot of people know you if they're in the options world, but now they see you as the representative of these highly successful, very popular products that are using options, income, heaps of it, yield max suite, and it's spurred a lot of, I think, kind of imitators too. So tell me firstly about how you've kind of received the growth of this market. How do you feel about it?
Yeah, look, this is, I like to say when it comes to these ultra high dividend products, right? High distribution products, we're kind of defining a new asset class, right? So it's not uncommon for other folks to kind of see that and take their, develop their own take on it. And that's okay. Like, we welcome competition. It's fine. It helps actually support the concept of the industry, right, so to speak, right? So it's great. It's great to see other issuers come out. We actually welcome a community of other funds that have high distributions, because again, it's one of those things. It's clear the investors want them. You talk about the growth, right? You go back to 2022, there was hardly anything in this kind of options based high distribution world, but there's been some like originals in this, right? Look at the JPIs, QILDs of the world,
right?
And they were kind of breaking this first ground using covered calls and distributing something like 10 to 12%. And that was obviously very interesting and was proof of concept. We then took the twist of single stock, right? Okay, can I do a covered call on a Tesla or on an NVIDIA, right? Oh yeah, we can. And guess what? IVs are much higher, implied volatilities are much higher. Yeah, and so now you start to distribute things like 40, 50, 60% on an annualized basis, and it opens a lot of eyes. So again, little groundbreaking. We understand other people are here, but the growth has been supported by the investor. When we look in our space, it's, we're probably approaching 20 billion of assets just in these types of funds. And so clearly, if the world keeps buying them, we'll keep making them.
Right now, I'm literally tweeting this out that you're basically kind of the king of the hill of ETFs in my mind for right now, Tidal, because of the representation. And this is really interesting. You set me up perfectly for something I wanted to talk about, which is how the line is kind of blurring between what we talk about in retail and what we talk about in institutions. Here, it's a much more institutional vibe than we were at in Robinhood last week. However, you just gave a shout out to Kevin Kelly of the QILD, and that kind of way that there was this platform kind of built, this runway built to get to where we are with these funds. We talked with him at Robinhood last week. There's an irony that we're having very similar conversations at this highly institutional event as we did on the show last week at Robinhood. What do you make of that?
Yeah, look, always good for a shout out for Kevin, right? So he's a partner of ours in a few funds. But yes, it's interesting to watch that. He was a leader here. We kind of replicate, and then now he has a Bitcoin, right? Strategy, right? So does Yield Max. So does actually almost everybody in the space at this point.
Exactly.
Right?
And so you've got people with massive institutions that are kind of swimming in the same waters as everyday investors. Is that just kind of is the option, the linkage between that, the options instrument?
Yeah, I would say when you look at, say, the retail investor versus the institutional investor and the advisor, the adoption has yet to make its way outside of the retail space. Right, almost all of the assets in these funds are really coming from the retail side. When you look at like the largest holders of any of these ETFs, the largest holder may be $4 or $5 million. That's it. And on a $5 billion fund, you go, well, it has to be this humongous swath of retail investors that are just pouring in, and that's really the case. So I don't even think we've seen the institution adoption
do you break
yet.
That wall down? Is that why you're here?
Well, always, right? I always love coming to the SIBO Risk Conference because it's just one of those things that you get to meet all the professionals in the industry, get to hear what all the innovative ideas are that are going on there. And yes, of course, now look, this group here is a little more institutional, right? We're not buying, this is not really where a lot of the, I'll call them allocators go. They may come here to learn. This is more what I like to say, the pipes, the nuts and bolts of what keep the ETF and the derivatives markets working so well. Yeah, of course, we want to get more exposure here. Here being in Munich, maybe there's opportunity to apply to Europe, right? I think that's around the corner for all of us.
Do you think that these types of funds are an answer to advisors who want to try and deploy an option strategy for their clients? Even if they're big advisors, if they're in the $5 to $10 billion range and they're going, we don't really use options, but it seems like everybody is. Are these funds a representation or an alternative for them to just say, all right, let's park some money here and let you do my options magic for me?
Yeah, absolutely. I mean, there's no doubt that that's the way. When you look at the past, the big adoption has come in the what's in jeopardy these days, $40 billion in that product. That's a lot of institutional use that's happening there. We expect the same thing to start to occur in these newer funds, even these ultra high yield funds that we're talking about here. And look, Tidal likes to be on the forefront of this, whatever the product can be. The only other thing I would add here is sometimes it takes time. Right, time. The proof will be in the pudding over time. Yield Max is approaching 3 years at this point, so seems like it's going to be here and still growing. Right, so I think you need time, you need to watch assets, and you need to learn a little bit about some of the dynamics so you know how to manage client expectations.
To that point, it's Risk Management Conference, and you got a question along these lines yesterday on the panel, which was a great panel. I brought it up to our AI. If we run the second, we've got my AI consultant here instead of my co-anchor. And basically, to pull that up, I asked it, okay, if the proliferation, because we're talking about the proliferation here of these types of funds where you guys have kind of led the way. But as you mentioned, there's a lot of now competition. So if the size and the amounts of invested money keeps going up in these options-based strategies, I asked, is there any structural risk being introduced through the popularity of income-generating option strategies and ETFs? And it basically says that it looks safe in calm markets, but when volatility spikes, if they all rebalance at once, it could amplify stress. When volatility breaks, the unwind will be synchronized. What do you think about that response?
That's a complicated response from your.
It's not bad.
It's not bad at all.
Is the AI thinking too hard, or is there a potential if a volatility regime changes and the amount of income you can expect to reap from these things changes really quickly? Could there be an outflow situation that stresses any of it?
Yeah. So always outflows can be stressful for any asset class. However, because of the frequency and the active management, at least in our funds, I think it's activity that we're already doing every day, right? We turn the portfolio over weekly, right? We're selling weekly options, right? So all of the connections to the liquidity providers, very regular. We know who's on the other side of every one of our trades all the time. Can the industry handle just that flow of orders? Yes, because they're getting it all the time from us anyway. There's money flowing in and out of these funds every day. So there's daily trades that happen all the time.
It's not like,
this is not going to look. Of course, any event can stress any system, but this is not a monthly or quarterly trade. These are sometimes 2-3 times a week. You're rolling over the portfolio. You can get a Tesla, like the beginning of this week, moves 5-6%. Guess what? That's an event for a covered call strategy. You got to roll the whole thing up. BABA, been a big mover lately. But then you can get the flip side and you get the monsters like MicroStrategy, this slow decline. You're constantly rolling that portfolio down to capture more income. So I am less concerned about the pipes. Now, if you had asked me that question 2 years ago, I would have said, geez, I don't know what's going to happen in NVIDIA, right? We had a huge NVIDIA move in the beginning of July or June of 23, July 23. That was an initial test to see what happens with inflows and a large market move. So far, strategies and all of the activities between market makers, primes, custodians, all linked together, working fine.
Not to do your marketing for you, but the way I think about it is that because we're talking income, the risk seems like it would be a gradual, lessening of the income, and that it's not like it doesn't seem like a crash risk to me. What it seems like is like the more likely problem is that maybe the market starts to arb away some of this volatility, and you can't harvest as much.
Well, yeah, well,
a different problem.
That is a different problem, but
a slow one.
I will tell you, we see our biggest inflows on the down days. Right. Okay. So if you're in the yield space, right, and you're doing your math and you have an idea what the dividend's going to be, if you could buy a stock or buy the underlying at a 10% discount, what have you just done? You've increased your yield, right? So we see more inflows on down days than we do up days. Take a look at April.
Because vol up is good for you.
Well, vol up's good. We're selling for more premium, of course. And then the end investors buying the ETF at a discount than it was, say, 3 or 4 days ago.
Is this, and we got Mike coming up because I really, one last question here.
Yeah.
Is that What about the scenario where vol goes down? Because it seems like a lot of the success of these funds is the environment where we've had price go up and we've had vol go up. So price goes up and your underlying is great, and then the vol's high, and you just keep harvesting that income.
Yeah, and it increases on the way up.
Right. Yeah. What about vol down, price down?
Yeah, MicroStrategy is a perfect example. Vol's been down as Bitcoin's vol's been going down, and the price has been down, right? Yeah. We're at 434, and now we're sitting in the high or low threes.
Right.
That drop has been accompanied by a drop in implied volatility. Still able to generate that 50-60% annualized rate.
It stays at that reduced vol, though. That's going to come in, and you have to say to your investors, you have to give an update, say, hey, look, we can't target 45 this time if thing's not moving that much anymore.
Yeah, look, Apple with a 20 IV is never going to be able to pay out 60-70%, right. And that's okay. Just you know what you have.
Okay, love it. So the worst case scenario is your stock it turns into Apple. Okay, no, we'll continue to monitor. It's a very fascinating space. I think it's really spot in the middle of what this show's been about. What we've talked about here versus Hood Summit last week, the use of options, and the way it's kind of blurring that line between professionals and individuals. Great stuff, Jay. Thanks.
Oliver, it was great to be here.
Appreciate it. Thanks. Jay Pestrichelli, Tidal Funds.